Thank you everyone for joining us today. Today's webinar, we will be talking about the differences in taxation between the UK and Gibraltar. For those of you considering relocating, regardless really of where you're moving from or to, it can be a complicated process. You need to understand what you are doing and all that's involved in that. And that's what we're here to help you with today. We have run further webinars in the past on Gibraltar residency, property, tax scheme, employment schemes, and other details. So please visit our YouTube channel, Fiduciary Wealth, to access these. And please subscribe and you can receive all our future content. Because in addition to this, last week we launched our Money and Finance for Expats podcast, which you can see there. So once a week, 10 a.m. UK time, you can join us. You can access these on Facebook, YouTube, Spotify, wherever you get your podcast content. So again, another great reason to subscribe to our YouTube channel. So today's webinar, planning before relocating to Gibraltar and how this compares to the UK from a taxation point of view. So briefly cover today's agenda. We're going to start by covering the importance of exiting the UK and your UK domicile. We will follow with a comparison of the taxes between the UK and Gibraltar. After this, we're discussing briefly the impact of Brexit and the residency options available and the tax planning opportunities that are available as a Gibraltar resident. We will then finish with some information regarding the Gibraltar-Spain tax treaty and post-Brexit negotiations, which are important, are ongoing. And we're finished with some final advice. We are happy to take questions and please submit those using the Zoom function. We will answer all those at the end of the webinar, but feel free to submit those throughout. So before we start the webinar, I'll make a very quick introduction for those who haven't spoken to us before. So it's Fiduciary Wealth Management here based in Gibraltar. My name is Matt Penfold, advisor and director here at Fiduciary Wealth. I've been working in financial services for 20 years, having spent the last 4 years working here in Gibraltar, but living across the border in Spain, having relocated myself from the UK. And I'm here with Paul Correa. Paul is our managing director and the co-founder of Fiduciary Wealth. Paul has extensive years of experience in financial services with a strong private banking and wealth management background, and he co-founded Fiduciary Wealth in 2007, partnering with Eastlanders 1892, who are the oldest law firm in Gibraltar. Now, aside from our legal roots, Fiduciary Wealth, we're also a member of MGI Worldwide, which is a top 20 global network of accountants and tax advisory companies. So Paul, I will hand over to you to discuss the UK side. So the importance of UK domicile and how this ties into UK inheritance tax.
Should I address the UK exit first, or?
Yeah, absolutely. Yeah, please.
Okay. So there are many different factors which will determine whether an individual is UK tax resident or not. And the number of days that you actually physically spend in the UK during a tax year is an important consideration, but it's not the only factor to take into account. You also need to think about your pattern of presence and your connections to the UK. And this can include everything from your family, your property ownership, your working life, if you've got businesses in the UK, and also your social connections. So it is the UK Statutory Residency Test 2013, which allows you to plan the date in which you become non-UK resident for tax and determines how much time you can spend in the UK without accidentally triggering residency. So this is all based on ties. It is outside the scope of this webinar to go into the detail. Each individual is completely different in terms of the ties they have, but we are happy to engage with you separately and individually after the webinar if that is a concern of yours, because inevitably we find that most Brits do want to come back to the UK during the year, not to spend an inordinate amount of time, but certainly to enjoy family and other aspects of UK life. So it's really, really important when you want to exit one country, the UK, for another, that you do so preferably at the end of the UK tax year, which, as you all know, ends on the 5th of April. Mainly because it's cleaner to do so. However, you're not precluded from splitting the tax year between, say, the UK and in this case, Gibraltar. So there's 3 specific ways in which you can do so automatically without requiring further guidance. If you seek or obtain employment overseas, then that is one exemption. If your spouse or partner has secured employment overseas, that is second exemption. And the third one is if you dispose of your main UK residence. So preferably clean tax year, because it works better. Fallback position is to do it on a split year basis if you can satisfy one of those 3 conditions. And then the third option is haphazard exit from the UK with unknown tax consequences. So that's the UK statutory residency test. I don't know if I've covered it in its entirety, Matt, but I think it covers a fair bit of ground. And then, if I may, I'll touch on UK domicile and how and the potential tax consequences. So, well, yeah, I guess the good news is that there's no inheritance tax in Gibraltar whatsoever. The bad news is that you're likely to remain exposed to UK inheritance tax because it's based on the concept of domicile of origin or of birth, as opposed to the concept of tax residency. So no inheritance tax in Gibraltar, but you have to be mindful that due to your domicile of origin, you're likely to be exposed to UK inheritance tax, and you need to protect against that. So domicile of origin is something you acquire at birth, normally taken from your father. And whilst you can claim and acquire a domicile of choice by settling in a new country with the intention to stay there permanently, in our experience, it's always fraught with difficulty. There are no fixed rules, there's no guidance. The burden of proof ultimately falls upon you, the individual, to demonstrate beyond any reasonable doubt that you've acquired a new domicile of choice. And in our experience, in any event, it's not uncommon for Brits who move abroad to then decide to return to the UK temporarily, and mainly due to ill health or perhaps the passing of a spouse. On a more permanent basis, they decide then to jump ship and come back to the UK. And even if you do so on ill health, on the basis that you want treatment by the NHS or privately for a year is enough to undo all the tax benefits you've acquired by choosing a domicile of choice and with intention to stay permanently. So even if you were to successfully acquire that domicile of choice to extract yourself from UK inheritance tax, just 1 year of back in the UK is enough to retrigger your UK domicile of origin. Now, theoretically, looking at the textbooks, you can avoid UK IHT after 5 years of non-UK tax residency. But in practice, I think it's much more complicated than that, because, as I've said earlier, ties like your business interests, your social connections, your family, where they are, property ownership, if you've got property in the UK, and something which is the old catch clause, which is your intentions, which I'll explain a bit later. Any of those can result in you being considered domicile for UK IHT. So it's not that you can extract yourself from the UK tax net that easily. And that's a thing to keep in mind. And certainly you cannot do it on your own without proper advice. And we know for a fact, Matt, that insignificant ties can be and have been challenged many times before by HMRC, and they will rely on the most tenuous of grounds to dismiss a claim that an individual has correctly and acquired a domicile of choice. I mean, just by way of example, the most high-profile case is that of the late Welsh actor Richard Burton. Many of you will know that he lived many years in the US before deciding to move to Switzerland in 1957. He then lived in Switzerland for 27 years until he passed away in 1984. He'd had professional tax advice of the highest quality, but the UK tax authorities made a successful claim on his estate on the grounds that he never intended to relinquish his UK domicile. And considering that he had already severed his UK ties for 30 years, it's quite surprising that they were successful in their claims now. The fact that he purchased a burial plot in Wales was sufficient grounds for HMRC to claim that his emotional ties were always with the UK and that he always intended to return to the UK. And the fact that he apparently was buried in the colours of the Red Dragon, of Wales colours, and holding Dylan Thomas poems, again, just was grounds on which HMRC could claim. Now, as a result of that, his worldwide estate, which at the time was valued at £5 million, was subject to a UK IHT bill of 2.4 million. So, you know, yeah, it can wipe away your legacy at the drop of a hat, just like this. So these are the things you need to keep in mind. The good thing is that once you become non-UK tax resident as an expat, there's tax planning opportunities available to you to restructure your assets and your financial affairs in a way that will either mitigate or completely eradicate your UK inheritance tax liability, again, with a caveat to that statement that it all depends on your own personal circumstances. And the first port of call is to speak to a professional that can look at your situation and determine how best to mitigate or eradicate that exposure.
Wonderful. Thank you, Paul. That's perfect. So we'll move on to the next section and we will do a quick comparison of the taxes between the UK and Gibraltar. And we're doing this on the basis that you know, you're either a tax resident in the UK or Gibraltar. And by that, it means you are spending sufficient time in that particular jurisdiction and you are meeting the residency requirements in that place, but also that you are not triggering a second tax residency elsewhere, which is sometimes a concern and something that we've covered in a previous webinar. So, I mean, the first tax we've got listed in inheritance tax, and Paul's covered that very well there. Not much more to add. You know, Gibraltar, there's no inheritance tax. In the UK, it's 40%, with the very large and important caveat that just because you've moved out to the UK doesn't mean you're not exposed to UK inheritance tax. In fact, it is very likely that you will. And as Paul mentioned there are opportunities as an expat to plan against this, and we will cover a little bit of that later. So moving on to income tax, and like many of the taxes, you know, they're considerably lower in Gibraltar in comparison to the UK. So the UK, it works on a progressive tax rates. It's 20, 40, 45%, depending on your income levels. Gibraltar works very differently and has historically worked on a bell curve rate. So what we mean by that is as you earn more, your tax rate increases,
but then it reaches a peak, and your earnings after that, it actually stays level or decreases down. So the way that works out is that pre-COVID, your income tax rate in Gibraltar would be never more than 25%. That's actually now 27%, but this is just for 2 years since the last budget. And that's for the local government trying to kind of recoup a lot of that lost income during the COVID period. So we're looking at a maximum of 25% in normal times, compared to up to 45% in the UK. There are also kind of special tax schemes that are available in Gibraltar for people of a certain net worth, people bringing particular skills and employment here, and there we might cover a little bit that later, but again, that's covered in more depth in a previous webinar. Capital gains in Gibraltar is zero, compared to the UK, where it's 18 or 28% based on your income tax rates. So there's a substantial saving there, especially if we take into account the most recent UK budget, where they're reducing your capital gains allowance there as well. So for those in that sort of position who may be looking to realize a large capital gain, being resident in a jurisdiction such as Gibraltar could be very beneficial. We have to add the details, though, that if you do realize a gain after you exit the UK, you cannot return until there's 5 full tax years. Otherwise, then that liability returns to you. And you would continue to pay capital gains in the UK on things like property that's physically held in the UK. We move on to dividends, and in the UK, this is anywhere from 8.75 to 39.35, depending on your income tax band. In Gibraltar, this can be very interesting, and it's something that, again, we have to have conversation with individuals about that, but it is possible to receive dividends from a UK company free of tax in both jurisdictions. So again, I add, if you're in a position where you can draw dividends from your company, you're seriously considering relocating to Gibraltar, then I think it would be very worthwhile reaching out to us. Let's assess your situation and see how that looks for you. No VAT in Gibraltar locally compared to 20% in the UK. And then finally, we've got pension income. So you hold pensions in the UK, that's added to your income tax rate. So again, 20, 40, 45%. If you are able to transfer your UK pension to a Gibraltar QROPS, or set up a Gibraltar QNOPS, which we will cover a little bit later, then the tax on that income is capped at 2.5%. So again, for somebody relocating or planning to relocate in Gibraltar, we should have a conversation with you regarding that, because there's a great opportunity to save tax there. So that's a nice kind of summary of the taxation. I think it's very clear the differences. Gibraltar is a much more friendly tax environment than the UK, and that's why there is so much interest in people looking to relocate here, especially if you couple that with the lifestyle benefits that come with living here in Southern Europe. So Paul, moving on to the next section. So Brexit's been with us for some time. So can you tell everybody a little bit about how Brexit has impacted on those maybe looking to move to Gibraltar?
Well, there's a new post-Brexit reality for Brits moving to Gibraltar. Right now, all residency applications which are processed under the provisions of Gibraltar's Immigration, Asylum and Refugee Act continue to treat British nationals who have no material connection with Gibraltar as EU nationals. But we remember that the self-sufficiency regime was born with the approval of the EU when Britain and Gibraltar were an integral part of the EU. So individuals wishing now to take up residency in Gibraltar must do so as a qualified person, whether you're an EU national, a third-party national or a British national. So the practical effect of this change is that as a British citizen, you may only take up residency in Gibraltar on a self-sufficiency basis if you are a UK pensioner who intends to make Gibraltar their permanent home, and where they are prepared to transfer the UK medical rights from the NHS to the GHA in Gibraltar. Yeah, so you're past retirement age, you're transferring your UK medical rights. And the second instance, when you can enter the country on unemployed or self-employed basis. If it's an employed basis, it's very simple, right? You've sought employment locally and you've secured your employment, and that ticks a box. If you want to do so under the self-sufficiency regime, then you now need to be self-employed. And the thinking behind that is that, you know, you have to contribute towards the local economy to benefit, to partake and to make use of all the benefits that it affords. As opposed to on self-sufficiency, we had many cases coming over and paying no tax whatsoever. And I think we have social media influencers, wannabe politicians all making noises that they want to tighten up on self-sufficiency. I think they already alluded to that in the July budget. So the requirements basically have become much more onerous, and I have to repeat, they are subject to change in the future. So nothing stays the same. But no, we are successfully processing, as you know, Matt, applications on self-sufficiency grounds, but they have to meet the new conditions. And the important thing is you can mitigate tax, but you have to pay towards the local economy as you're going to benefit from it. But if you're trying to get residency now, if it was complicated before and processing times were 4 weeks, it can take upwards of 12 weeks or more to secure residency. There's a lot of hoops. It's complicated, it's difficult, it's long-winded, and you're better off hiring the services of a professional firm like ours that can secure residency for the individual. And yeah, so clarity on tax residency options. There's 3 routes to market. One is HEPS, which stands for Higher Executive. When you have some special skills, you can contribute to the local economy. And then I think you have to have income of, I think it's been revised to 170,000, but I stand to be corrected. And then you pay a flat rate of tax, which is capped. Still quite a lot, but it's capped. The second route to residency, if you've got income from global sources and they are paid gross, and then you can declare all your income here and pay a maximum flat rate of 44,000, I think it is. But those are really for the ultra high net worth, where they have income from multiple sources, all paid gross, and they can pay it in one place and pay a flat rate of tax. And that has been increased recently to 44. And the third one is the one we've touched upon, which is probably the most popular, because HEPS is really for senior executives in gaming and DLT ledger and finance, that are accountants, lawyers that might relocate, and they provide a specific skill set. And CAT2 is for the ultra high net worth, yeah, for the entrepreneur. And then the self-sufficiency is more for the retiree that is still in receipt of some kind of income from maybe self-employment in the UK, and they can declare the income here as consultants or whatever. So there's those 3 routes. I don't think we're going to go into the detail of the 3 routes, otherwise it's going to be a very long webinar and it's going to be very boring as well. But you know, I think as always, the devil is in the detail. They can approach us and we can explain the 3 routes to market.
Perfect. Thanks, Paul. And it's exactly that. We run these webinars to add value and give information, but for us, if we're talking about relocation, the management of your wealth, there's never a one fits all. We can tell, an audience of various people, you should do this, you should do that. And maybe there are firms out there who do that, but it's not how we operate. And the most important thing, if you're really serious about moving to Gibraltar and you want to take advantage of the tax benefits, then we can have a conversation with you, we can assess your situation, and we can guide you through the process and process your residency application. As Paul says, I think, yeah, very generous, and it's quite arduous now. It's a pretty much nightmare, and people may think you can do it yourself, and that is possible, but it's very difficult. And not only we know how the system works, we have certain contacts that we can use to help with your applications. So we'll move on to tax mitigation and what options there. So I will cover a few options pretty briefly here for you. Again, we don't want to kind of bore you into submission today. It's about giving you information that can help you while you investigate your options of relocating to Gibraltar. So I'll cover from a kind of pension point of view, and the first one is the Gibraltar QROPS. So this is the Qualifying Recognised Overseas Pension Scheme. I touched on this earlier, but you can transfer your UK pensions to a Gibraltar QROPS. And at the moment, you can do that. I mean, it's pension transfers are a difficult process at the moment, and again, we've covered this in a previous webinar. But it is still possible to transfer your UK pensions to a Gibraltar QROPS, and there's a few reasons you might want to do this. Probably the main reason is the income tax rates that I touched on before. Gibraltar QROPS, you benefit from 2.5%. Income tax rate on any income you take. That's in addition. You still retain your 25% tax-free lump sum, which can in some circumstances be increased to 30% if you've been out of the UK for enough time and here in Gibraltar. But let's just keep that at 25%. And then the remaining income, where you would pay minimum of 20 in the UK, you're paying 2.5%. The second benefit is if you are close to, or even if you breached your UK lifetime allowance. So the lifetime allowance with pensions, you may know, is a limit to how much you can build up in pension savings before you pay a very large tax on that. So the limit at the moment is 1,073,100, which has been frozen for some time and will continue to be. And if you exceed that limit, then you pay tax on that. Either, I think it's 25% if it's taken by income, or 55% as a lump sum. And so to cover this briefly, the lifetime allowance, you are subject to what they call benefit crystallizations events. That's when they assess how much you hold in pensions and if you are over this limit or not. So when you transfer your UK pension to a Gibraltar QROPS, this triggers a benefit crystallization event. So if you are close to or just under the lifetime allowance, there'll be no tax. And then after you transfer the pension, this can continue to grow over the lifetime allowance limit with no further assessment, no additional tax on that. Also, if you're already over that limit, at some point you're going to have to pay this tax on that. So, you transfer your pension to a Gibraltar QROPS as soon as possible. Okay, there will be a taxation on the excess you're over the limit. But again, once it's transferred, you can grow it more and more, and there'll be no more tax. So really, the sooner you can do that, the better from a lifetime allowance point of view. And also the death benefit. So we have a UK pension, and you pass away after the age of 75, then your beneficiaries will pay tax on that pension that they receive at their marginal tax rates. For Gibraltar QROPS, you're based in Gibraltar. You pass away regardless of your age. If your beneficiaries are here as well, then there will be no taxation on those. If your beneficiaries are based elsewhere, then it would depend on the tax rules in that country. Now, the second to cover is, and again, I mentioned this briefly earlier, is a QNUPS. So similar to a QOPS, it is a pension scheme, but the main difference is a QNUPS is funded from a lump sum investment as opposed to a QUPS, which is funded through the transfer of your existing UK pensions. So a QNUPS works very similar to a QUPS. So 2.5% tax on the income, the same with the generous death benefits. There'll be no kind of tax to your beneficiaries for that. But the main reason you may want to use a QNUPS is because it is a bona fide pension scheme. Any investment you make into a QNUP will immediately be outside of your estate for UK inheritance tax, even if you were to return to the UK in the future. So we talked, Paul talked earlier about your UK domicile and how that affects your exposure to UK inheritance tax. A QNUPS is an incredibly good way to plan against this. Now, there are caveats that the funding for the QNUPS needs to be it needs to be set up so it's a genuine pension scheme. So the funding needs to be in line with your age, wealth, and income requirements. So what we mean by that is if you have an individual, for example, who has a net wealth of 7 million, they come to us, they're age 75. Okay, I love the idea of the QNUPS. Let me put 6 million in the QNUPS. That's outside of my estate for inheritance tax. That wouldn't work. You know, HMRC would view that it's an IHT fudge. There's only one reason to do that, and they would see through that, and that would still be liable for inheritance tax. But if you're a little bit younger, if you're looking to set up some income that you can draw on in retirement, maybe you need to increase your kind of pension benefits, then a QNUPS could be a perfect opportunity for you to do that while shielding part of your estate from UK inheritance tax. So again, it's a really, really interesting planning tool that needs to be assessed on an individual basis, which we can have conversations with you on a one-to-one basis. So if you like the sound of that, reach out to us and we can have a conversation with you about that. So we move into the final section. I think I'll point out here, we had on our agenda that we would cover the Gibraltar property market, but our guest wasn't able to join us today. But I'm pleased to say we already have a webinar on our YouTube channel that covers the Gibraltar property market in some detail. So if that's something you're interested in, please, log on to YouTube and have a watch of that one.
Matt, the only thing I would say is that the Gibraltar property market is on fire right now.
Absolutely, yeah.
I mean, property prices have almost doubled in the last 2 years, during and post-COVID. There's a significant supply shortage and the demand is just building up. And of course, if there's a Schengen treaty, then the problem will be exacerbated moving forward. So it's a very well supported property market. The new luxury properties that are coming on stream are probably 3-5 years away. And so long as the demand is outstripping supply, I think prices will continue to increase. I think we've seen probably a leveling off of the property market in more recent months, but it's been just unbelievably strong, from early 2020 onwards.
No,
so
absolutely.
it's not easy. You can come and you want to rent or buy, and then you hesitate and procrastinate. Someone's bought the property or rented the property before you have to. So it is not it is not a market where you can blink, put it this way. Yeah,
no, absolutely. It's a seller's market at the moment, but I think all the noises and our assessment is that will continue, won't it, Paul? It's very simple. There's a lack of supply.
Yeah.
It's a relatively small jurisdiction, and because of a lot of the things we're discussing today and because of the great lifestyle here, there's a lot of demand. So no, it's a good point that if you are seriously looking at Gibraltar residency and you're looking at property, it's not, unfortunately, something that you can take too much time on there. You find a property you like, you need to go for that and make your move. So we move on to the last part, and there's a couple of sections. Paul, you would like to cover forwards? And
Yeah,
you kind of mentioned one there actually about the kind of EU treaty, the discussions with Spain. So what's happening with that?
well, there's different aspects to that. First, there's the tax treatment or the double taxation treaty that Gibraltar and Spain signed in March 19 with an effective date of March 2021. And the reason we are mentioning Spain in passing when this is all about UK and Gibraltar taxation is very simple. It's not uncommon for Brits to move to Gibraltar and then acquire a second home in Spain and be in Spain, but tax resident in Gibraltar. I mean, those days are long gone. I have to make it absolutely clear. So this treaty covers a wide range of areas concerning tax and residency, and it enhances tax cooperation and transparency between Gibraltar and Spain. One key element of this agreement is Spain's commitment to declassify Gibraltar as a tax haven in the future. Unfortunately, they have not kept their word and they haven't done so. But one would hope that if this Schengen Treaty is signed, then they will stick to, because it is an agreement that they will fulfill their side of the bargain. Now, the practical effect of this treaty is that people who are looking to move to Gibraltar with a second home in Spain, as I said, and spend the majority of the time in Spain will end up triggering Spanish tax residency. So that's not a very good idea. The treaty also states that special Gibraltar tax schemes, and we've mentioned them today, for high net worth individuals, whether they are HEPs, category 2, or even self-sufficiency, the holding a tax residency certificate from Gibraltar in itself does not constitute proof of tax residency for the purposes of this agreement. So it will be set aside and ignored and disregarded. So holding a tax residency certificate, I repeat, doesn't offer you protection against triggering tax residency in a third country, more specifically Spain, because you could still trigger residency in Spain, and the rules in Spain the guidance notes are very clear in that regard. But then what's particularly interesting of the agreement is that if you're planning to live on leaving Spain and then moving to Gibraltar, the agreement becomes a bit political in nature, as opposed to the rather dry double taxation treaties, which most, which are signed on a global basis, which follows a very set pattern. This one has these political undertones. So for instance, Spanish nationals who moved to Gibraltar after 4th of March 2019 will be indefinitely considered tax residents of Spain, regardless of how long they spend in Gibraltar. This is very different to a Spanish national who decides to move from Spain to Andorra to establish their tax residency there, and the Spanish tax authorities recognize that they exit one country and establish residency in another. With regards to this double taxation treaty between Gibraltar and Spain, they will not allow Spanish nationals to move to Gibraltar and sever their tax residency in Spain. So that's one thing. And then for non-Spanish nationals who are resident in Spain for more than a year, and then decide that they want to move to Gibraltar, they will be considered tax residents in Spain for a further 4 complete tax years. So I'll give you an example. John Smith moves to Gibraltar on the 1st of January, moves to Spain on the 1st of January 22, and decides to exit on the 1st of January 23. He's been a full and complete tax resident in Spain. He now moves to Gibraltar at the beginning of the coming year. And he says, fantastic, now I pay less tax, yeah? No. Under the terms of this agreement, you're still tax resident in Spain for a further 4 years after moving. So it means that you're still subject to submitting tax returns and declaring income in Spain. So that's not great. So if anyone is planning to leave the UK and establish their tax residency in Gibraltar, but decides they will want to take a pit stop in Spain to see whether Spain is a better location for tax residency, then they have to understand that they will be captured by this agreement and be tax resident for the year of tax assessment and the year that they live in Spain, and then for further complete tax years. So it's not a good idea to move to Spain first and then to Gibraltar. You have to make up your mind early on where you plan to establish residency. It's preferable, in fact, that you establish your tax residency in Gibraltar, and then once you're here, if you think Spain is a better option for you, move to Spain rather than the other way around. Yeah.
Perfect. Yeah, thank you, Paul. And there's still talks regarding, and I think you mentioned it earlier, about Gibraltar joining Schengen, and there's kind of talk still kind of ongoing, which they have been for some time. So that will have a bit of impact on people looking to move here as well.
Absolutely. I mean, there's no news to report. I mean, basically there's goodwill on both sides, the EU and the Spanish side, as well as the UK and the Gibraltar side. There's some red lines from what we understand. There have been very few leaks to the press. So it's all based on hearsay and there's nothing concrete to report. But it would appear that there's a few red lines and the British UK side will not give up, sovereignty, jurisdiction and control. Those are the red lines. Spain and the EU particularly want to cross those red lines. And I think that's where we are right now. If there's a treaty, then of course that would be extremely beneficial for Gibraltar in terms of fluidity at the land border, free movement of goods and of people, and the ability to use the hinterland because they've got the space to grow the Gibraltar economy could be very, very interesting. And I would agree with you entirely. If that were to happen, then the demand for Gibraltar residency will just explode. I think it will be a problem because there's not enough property in the pipeline to feed that demand if that were to happen. I'm not saying it will, but I think something might shift. I would imagine in the next 2 months, maybe by the end of the year, we hear something, or maybe there's a no deal. And then we will have to suffer the consequences of there being no agreement. But yeah, watch this space, Matt, for updates.
Watch this space. I know they've restarted talks again, but yeah, these talks have been ongoing for some time. So who knows what will happen. Okay, wonderful. So we're almost at the end of the webinar, but Paul, before we go, if I ask you one last question. So we have people here either as part of this webinar are watching on YouTube and they're interested in moving to Gibraltar. So if you were going to give them one piece of advice before for those looking, what would that be?
Well, there's a lot of information on the World Wide Web, some of it which is completely out of date, some of it which is inaccurate, and some of it which is completely unreliable. Yeah. And of course, there's some relevant information out there, but you can't piece it all together and based on snippets of information, try to determine how you establish your residency locally, and two, how you restructure your financial affairs. I mean, that's complete madness. You don't want to be penny wise, pound foolish, right? You need to be sensible. So it's a very bumpy road. This moving from one country to another is very unsettling. You really do need an advisor and a trusted individual by your side that can hold your hand throughout the journey, making it as easy as you possibly can, and more importantly, ensuring a smooth and seamless transition to your new country of residence, which is Gibraltar. I mean, failing to plan is planning to fail. I keep repeating that, but it's true. And you need a timeline, you need a strategy, and then you need an advisor that can help you execute that strategy, because there are many moving parts and there's many things to consider when you're leaving the UK, from pension consolidation and the impact of the lifetime allowance limit if you're close to or likely to exceed at some point in the future, and trigger a lifetime allowance. Maybe you want to transfer the pensions before or consolidate them. How do you do so in the most tax efficient manner? You need to consider the disposal of your UK main residence, when to do it, and how to make use of the exemption, because you have some exemptions. And again, there's a chronology or there's a sequence of events that have to happen at particular times to make sure that you avoid tax, be it in the UK or elsewhere. And then how do you restructure your financial affairs to reduce your UK inheritance or your potential UK inheritance tax liability? So missing a key step in the process, needless to say, can be very costly, Matt, and something we don't advocate. So the most important thing is you need to plan first. You need to give yourself a long runway to make sure that you go through the steps meticulously and in time, and then you can move later once the planning is already in place and everything is and then you can enjoy your lifestyle in retirement and pay less tax, which is the end goal, I would imagine.
No, absolutely, yeah, and we're here to help people score that end goal. We're here to assist people to hit the back of the net with that. So good, so wonderful. So we've reached the end of the webinar. Thank you for those who have joined us today. We don't have any questions to face. So that's good news for us, I guess. If we won't be put on the spot, maybe some of you are feeling shy, maybe you've got all the information you need from us today. But I think we repeat the same thing. We're happy to give this information to help guide your thought process. But if you are going to go through the process of relocating, and in this instance to Gibraltar, then you need that guidance. You need that advice as you go through the process to make sure you don't make any of those mistakes that Paul mentioned. So feel free to reach out to us. Fiduciarywealth.gi is our website, and our contact details are on there, and we'll look forward to speaking to some of you shortly.
Yeah,
so thank
can
you.
I just if I can just add something very quickly, please like and share. Go to our YouTube channel, like and share and subscribe to our YouTube channel, because then you have access to a lot of information which is going to be relevant to you, and I think you stand to benefit from being knowledgeable of the implications of moving to a third country.
No, absolutely. There's a lot of content on there already, and there's a lot more to come. So we'll look forward to speaking to some of you shortly. Thank you, and have a lovely day.
Thank you. Bye-bye.